In this video, we're going to go over what a call option is and what a put option is. For most of the strategies, and especially the ones that I talked about, and we use specifically in this series for SFW and ratio trading. SFW stands for small frequent wins, and that's a strategy that I've developed proprietary to my system. Ratio trading is very similar to pair trading, but it's a little bit different, and we're going to get into that a little bit later. But right now, because most of the strategies that I'm going to present you with use call options and put options, it's important to get a good, solid foundation for understanding what a call option and a put option is and the different variables that affect the prices of call options and put options. So let's start with a call option. In the screen in front of you, there's what's called an option chain. That means that there are various different options available for one particular instrument. In this case, it's the PowerShares QQQs, which is an ETF. Now, it starts out with a strike price of 31, and it goes all the way up to a strike price of 76 in this case. I'm sorry, it goes all the way down to 27. It starts with a strike price of 27 and it ends with a strike price of 76. Those are the only strike prices available for this particular ETF. On the left side, you have call options, and on the right side, you have put options. Now, a call option gives the owner the right, but not the obligation, to purchase a specific security at a set price during a set period of time. In other words, this particular option chain that we're looking at expires in 7 days. These are the December 2011 options, call options and put options. So a person who is interested in seeing the Qs go up would buy a call option. A person who is interested in playing from the short side of this market would buy a put option. So if they thought the Qs were going down, they would buy a put option. Now, the buyer of a option call wants the stock market to go up. The seller of a call wants the stock market to go down, or at least stay very near its current level. And there's specific reasons for that we'll go into very shortly. Everything highlighted in gray here on both sides, we'll start with the calls first, are in the money calls. And it is one strike price lower than the actual level of this financial instrument. For example, if you see the line right here at 56, these are what are called at the money calls. It's very close to the current price of the financial instrument, in this case the ETF. Anything below that on the call side is what's considered to be in the money. Anything above that strike price, above the current price of the ETF, is considered to be out of the money. It's at least one strike price higher than the actual level of the ETF. Now, the premium, these are the prices. This is the bid and the ask for this ETF options based on the strike price. And what you do is you pay a premium. Out of the money options also have a premium as well. But the premium of an in the money call, that means anything below the current strike price, has two components. It has a time value and an intrinsic value, or real value. The intrinsic value is determined by subtracting the strike price of the call from the actual level of the ETF or financial instrument. In this case, a 56 strike price, which is currently the current market price, $56.12 of this ETF, subtracted from 50 gives you a value of approximately $6.12. That's the strike price of 50 minus the current stock price of $56.12 gives you an intrinsic value or real value of $6.12. Now you can see that the 50 strike price call in this case is actually selling for more than $6.12. In that case, the remaining portion of the premium that you would pay for this call is called time value, and it represents the value investors place on the time remaining prior to the call's expiration date. So there's an additional value on top of its intrinsic value that gives it its price. An out-of-the-money call has no intrinsic value. In other words, there's no real value to these prices down here below, above the strike price. The 58, the 59, the 57, the 60 strike price calls. All of these calls with a price of 60 cents, 28 cents, 11 cents, 5 cents, and 2 cents have no intrinsic value.